Welcome to this eye-opening video on the banking system's coming collapse. While most people go about their daily lives without thinking about the financial system, the truth is that our banking system is on the verge of a cataclysmic catastrophe. In this video, we will explore the causes for the impending collapse, as well as how to prepare for what might be an unthinkable financial disaster. So if you want to protect yourself from the potential fallout of a banking collapse, make sure to watch this entire video and take notes on what steps you can take to prepare for the worst-case scenario. Don't forget to subscribe to our channel and turn on the notification bell to stay up to date with our latest videos. So without any further ado, let's dive into the video. The global banking system has been a pillar of contemporary civilization for decades, providing individuals and businesses access to financial services that promote economic growth and development. But there are rising fears that the banking system as we know it is about to implode. Several experts are warning that the banking sector is not prepared to endure the next financial catastrophe, citing the increased incidence of cyber attacks, economic insecurity, and rising debt levels. The impending collapse of the financial system is a painful truth for which we must prepare, since the ramifications might be catastrophic. This video will take a look at the likely causes and implications of a financial system collapse and how we may protect ourselves from them. What exactly is a bank failure? The FDIC defines a bank failure as the closure of a bank by a federal or state banking regulatory entity. This usually occurs when a bank cannot satisfy its obligations to depositors and other stakeholders. The perpetrator in the instance of SVB was a bank run. When depositors fear that the bank may fail, they rush to take all their cash at once. When more clients withdraw their funds, the bank's chances of defaulting and running out of cash rise. Bank failures rose sharply during the 2007-2008 financial crisis, but the banking industry has yet to witness such a high number of failures subsequently. Bank failures. The early 2000s were a challenging period for the banking industry, with an increase in the number of bank collapses. 2008 was the most difficult, with 25 banks collapsing in the US, leaving a path of financial devastation. This was partly due to the subprime mortgage crisis, which had a cascading effect on financial markets. Nonetheless, the sector has subsequently recovered, with the frequency of bank bankruptcies dropping gradually over time. Looking ahead, it is evident that the banking sector has learned from its mistakes, with a greater emphasis on good business processes and regulatory monitoring. The banking industry's overall assets have also increased dramatically, reaching a record $319.4 billion in 2022, demonstrating the industry's durability and flexibility. What are the reasons for the collapse of banks? Banks are the financial system's backbone, and their stability is vital to the global economy's health. Nonetheless, numerous banks have failed throughout history, disastrously affecting the financial system and society. Bank failures can occur for various causes, ranging from lousy lending procedures to fraudulent and unethical activities. Banks have collapsed in several situations owing to economic downturns or mismanagement by CEOs and senior managers. Bank failures can have a cascading impact, resulting in job losses, decreased consumer spending, and a general slowing of economic growth. To prevent bank failures and limit the consequences of any failures, regulators and financial institutions must preserve openness, promote ethical behavior, and implement effective risk management measures. Silicon Valley Bank. Silicon Valley Bank, a once powerful participant in the banking industry, went bankrupt after being unable to keep up with growth rates, which undermined the value of its assets. California authorities closed the bank, and the FDIC was named receiver. This is the greatest bank failure since the 2008 financial crisis, when Washington Mutual went bankrupt. Silicon Valley Bank sought to recoup its losses by selling a $1.8 billion portfolio of treasuries and mortgage-backed securities to Goldman Sachs. Nevertheless, it could not obtain the required $2.25 billion in ordinary equity and preferred convertible shares. Clients of the bank grew more concerned and withdrew their deposits, resulting in $42 billion in withdrawals in only one day. Silicon Valley Bank revealed earlier this week that it was evaluating strategic alternatives for its holding company, SVB Capital and SVB Securities, to save its companies. According to the business, the funds and general partner companies of SVB Securities and SVB, the Capital, was not included in the Chapter 11 petition. The firm also stated that it intends to continue the process of evaluating options for its operations as well as its other assets and investments. Signature Bank. Signature Bank, a mid-sized New York-based institution with around $110 billion in assets, was one of the victims of the panic induced by SVB's collapse. According to CNBC, state officials seized the company after consumers withdrew more than $10 billion in deposits. Later that day, the Biden administration said that it would take special efforts to guarantee that SVB and Signature depositors received all of their money returned, even the portion that were not insured. The government would utilize FDIC money to sell the bank's assets, with any remaining cash coming from a special assessment placed on all banks in the United States. Silvergate Bank. Silvergate Bank is a California-based bank that originated as a savings and loan organization in 1988. In the 2010s, the bank began to offer financial services to Bitcoin market participants. In the summer of 2014, the bank sought regulatory authorization to conduct business with cryptocurrency startups. The bank significantly increased its assets on its balance sheet, more than doubling its assets to $1.9 billion in its 2017 fiscal year, by servicing cryptocurrency exchanges and other companies involved in the cryptocurrency business that could not secure financing from larger, more conservative banks. Despite its fast expansion, the bank retained a modest physical presence. In 2018, it had only 3 locations, all in Southern California. By the fourth quarter of 2022, 90% of the bank's deposits were cryptocurrency related, with over $1 billion connected to Sam Bankman-Fried. Now, the second and third largest bank collapses in U.S. history occurred last week, affecting Silicon Valley Bank and Signature Bank. The Federal Reserve's aggressive interest rate hike created a $620 billion black hole in the banking system, and our quadrillion-dollar derivatives pyramid scheme is now shaking at its core. Like Silicon Valley Bank, 186 American banks are at risk of collapse. According to a recent analysis, 186 banks in the United States are at risk of failing due to rising interest rates and a significant share of uninsured deposits. The study, titled Monetary Tightening and U.S. Bank Fragility in 2023, Mark-to-Market Losses and Uninsured Depositor Runs, and published on the Social Science Research Network, evaluated the market value loss of individual banks' assets throughout the Federal Reserve's rate-increasing campaign. When new bonds have higher interest rates, assets like Treasury notes and mortgage loans might lose value. The survey also examined how much of a bank's funding came from uninsured depositors, with accounts worth more than $250,000. Suppose half of the uninsured depositors withdrew their cash from these 186 institutions immediately. In that case, even insured depositors may face impairments, since the banks would not have adequate assets to compensate all depositors. According to the publication, this might push the FDIC to intervene. The study's experts caution that unless the government intervenes or recapitalizes these 186 institutions, they will face a similar destiny. The findings emphasize the significance of prudent risk management and the diversity of financing sources for banks to maintain stability in the face of market changes. Is my money secure? Regular folks have little need to be concerned about their finances. Deposit protection is in place in the highly improbable event that a bank or building society fails. Now, the Federal Deposit Insurance Corporation insures all deposits up to $250,000 in value. In addition, the FDIC has an excellent track record of protecting deposits over its maximum. Almost all banks are FDIC insured. The FDIC logo can be found at a bank teller window or on the entry to your bank branch. The National Credit Union Administration insures credit unions. Individuals and organizations with substantial deposits are advised to diversify their savings among many financial institutions, as the FDIC protects up to $250,000 per bank. Now, federal officials have put in place safeguards to ensure that clients at other banks do not panic and remove savings. What to do if you're concerned about bank collapse? If you're concerned about banks failing, remember that money placed into bank accounts is safe if your financial institution is federally insured. Individual bank accounts can hold up to $250,000 in funds. According to Michael Collins, an Endicott College business professor, the government will step in and ensure that consumers have access to their insured deposits, so they don't lose any money. Wheelwright also suggests learning where your bank's money is being invested. Financial institutions with diverse portfolios are more financially stable and less likely to collapse. Several banks' websites may provide information about their investments. You might also learn about the many loan options available at a financial institution, and if it has been designated as a community development financial institution or an eco-friendly bank. The possibility of the banking system collapsing is terrifying, but it must be taken seriously. This might imply diversifying our finances, stockpiling emergency supplies, and looking for alternate sources of income. Finally, we must acknowledge that the existing banking system may not be long-term viable, and we must be prepared to adapt to a new financial landscape. We can weather the storm and emerge more robust and resilient than ever if we stay aware and take proactive actions. Stay tuned for our next video, and thank you for watching.